Hello, my name is Adam with Infinity Accounting, and I'm presenting another course in Small Business Accounting, a deeper dive into the chart of accounts. Like I just said, my name is Adam. I own Infinity Accounting LLC. We do accounting, bookkeeping, payroll, and tax. We also do profit consulting, which is basically a fancy way of saying we look for ways to make your business more profitable. I've listed my internet address, my email, and my phone number. We're located out of Germantown, Wisconsin, which is just north of Milwaukee. So if you have any questions or concerns about the material, please feel free to email me, give me a call, or if you're interested in learning how we can help you in your business, we can book a 1-hour consultation as well. All right, the last video we talked about the different types of accounts again, revenue and income, expenses, assets, liabilities, and equity. I also will indent into the accounts. I'm going to be doing another video on basically how to go through a accounting system, going through some transactions, putting those in T accounts, and seeing what they look like on that from that view. Before I did that, there are some accounts that might be tricky to some people who are newer to accounting, so I wanted to kind of go through those real quick. And that's depreciation expense along with accumulated depreciation. On the asset side, we have accounts receivable and fixed assets. For liabilities, we have accounts payable and notes payable. And for equity, we have owner's investment. Just a quick overview of expenses. Basically, generally speaking, they're paid when the expense initially occurs. So we think about how we use our debit cards. When you go to Best Buy or Home Depot or the grocery store, basically you give them your debit card and it's taken out of your account right away. Basically, that's how we record expenses. Right when it's incurred, basically we're taking it out of the accounting system and recognizing it at that point. So for example, if you go to Vistaprint and get some business cards, if you're getting bank fees taken out from your bank account, if you have a rent agreement where your rent is basically taking out at the first of the month or whatever, if you have supplies or office expense, you go to Home Depot and that comes out of your account. Basically, expenses are being recognized right away. I just want to switch to assets as well. For assets, on the asset side, we have an account called accounts receivable. So assets we talked about are things that you own. So they're things that you own and have rights to. So accounts receivable is an account used to track the amount of funds that are owed to you by your clients or your customers. And when any service is invoiced, there's usually an entry to accounts receivable involved, or there should be at least. And I wanted to actually show you how that looks from a T account point of view. This is basically the bare bones of accounting, the sort of concept of what T accounts look like here. So I have a little T account set up here. So we have accounts receivable and service income. So let's say we did a service for $500. So we did the service and then we invoiced the customer. So what we're doing was we're recognizing the service income of $500 that we earned by performing the service. Then we're also recognizing that we have rights to the money that we invoiced for $500. I hope that makes sense. Okay, I went backwards. Also, there are other assets in the accounting system. There's something known as fixed assets. So basically assets that a business acquires that costs us more than $500 that's useful to the business. Examples can be free vehicles. If you get a company car or vehicles, like for example plumbing or a lot of contractors, things like that, they have their own vehicles that they go out and do jobs for. Furniture, just for the office, computers, machinery, equipment, etc. Those are all fixed assets. So the assets cost is depreciated over time versus expense right away. So for an expense, we expense that right away. Basically, that month or that time period, it's being as a reduction of our income. Versus a fixed asset is going to be depreciated over time. The IRS basically is saying, hey, you have this big expense, but we don't want you to take it right away. So instead, you're going to basically depreciate the cost or expense it over a time period. So there's the most common depreciation methods are known as straight line. So basically, straight line is you're expensing the cost equally over a set period of time, and that's the one I'll use in an example. There's double declining balance. So if you have machinery and it's going to be more useful in the beginning, you're going to take more of the depreciation at the beginning, and then at the end, as it tails off, you'll be taking less. And then there's units of activity, basically a machine, how many units of output can it stand, or will it put out, and basically depreciating it based on its usage. And then there's also something called MACRS, which is, I believe, the Modified Accelerated Cost Recovery System. It's basically a formula-based system that the IRS uses to determine depreciation for tax purposes. For depreciation, we use two accounts. We use depreciation expense and accumulated depreciation. Depreciation is what I call a paper expense, meaning there's no like real tangible transaction taking place, but you're still basically accounting for the cost, as like I mentioned before. And these accounts are used to track depreciation in an accounting system. So I will, before I jump ahead, I'll show you how depreciation works on a T account system. So let's say we bought a computer for $750. So right here is our entry for computers and bank. So we bought a computer and we came out of the bank account. It's an asset, it's debited, and then we're removing money from the bank, so that's a credit. And then, like, let's say we set up straight lines. So like I said earlier, a straight line is basically setting it up and you're depreciating it equally over a set period of time. So we take into consideration the cost and its life. So for computers, the IRS determines typically computers have a 5-year useful life, and determining from technology moves so fast lately that basically after 5 years you're probably going to need a new computer. So what we do is we take 750 divided by 5 years, or 60 months, and you see right here, that's my formula. 750 divided by 60 is $1,250 a month, or $150 a year. So when we record it monthly, we debit depreciation expense, which is $1,250, and then we also credit an account called accumulated depreciation as the credit for $1,250. Accumulated depreciation is basically a tally of how much depreciation is accumulated on a given asset over a period of time. It also helps to track book value on the balance sheet. So on the balance sheet, you'll have your computer here for $750, and then below that you'll have your accumulated depreciation. So for the year, let's say for like a 12-month calendar year, you've depreciated $150 of it. So your it'll list basically your total asset amount for that time, which is basically your book value would be $600 for that asset. Let me go back up here. Okay. Accounts payable is on the liability side, is an account. Accounts payable used to track what you owe that will be paid at a later date. Usually it's debts that are due within 365 days or a year. Example, this would are utility bills, phone bills, and basically anything where you receive a monthly statement to pay later. It's increased with a credit and reduced with a debit. So basically you'll go to your accountant and say, hey accountant, I got this bill. Can you just enter that in real quick? And he's like, okay. So what happens here, like this example that I'm going to be using, so let's say we got the telephone bill. They enter the telephone bill as a telephone expense, and then credit to accounts payable. So basically you recognize the expense, and then you're also recognizing that you have a payable on your books that's being owed. Say 2 weeks later, you say, okay, I want to pay the phone bill. So basically you debit accounts payable. Basically this washes out that debt to zero, and then you pay out of your bank account. Notes payable is another liability to discuss. Notes payable, as contrasted to accounts payable, is for debts owed for more than 365 days. So for example, a bank loan or a personal loan. So let's say you starting up your business, you have pretty good credit. Bank likes what they're seeing, and they give you a loan. So bank says, okay, we're going to give you a loan for $35,000. So in order to record this transaction, you say, okay, we're receiving $35,000. In exchange, we're signing a notes payable saying we're going to pay this back to them. So that's right there. And then usually about a month later or so, you gotta record your first payment, obviously. So basically, they're gonna charge you. Let's say they charge you $125 of interest a month, and your payment is $1,000 a month. So you would record you would debit interest expense here, and then you would also recognize that your notes payable is being reduced by $1,000. So then this is $25,000, and that's your bank. You're taking $11.25 out of your bank to pay this. And then here's the balance sheet. What it would look like. Basically, your notes payable would be $35,000, and then if you run your balance sheet after the payment, you would basically see a $35,000. I don't know how to add, apparently, or subtract. That's really wrong. $34,000 balance on your notes payable. Okay. Payroll liabilities. Payroll liabilities are usually really tricky to new business owners and even existing business owners. They usually have either Paychex or ADP handle them. But I'm gonna show you basically the concept behind a brief overview of how payroll rolls. Typically, it consists of four-part. That's supposed to be four. There's wage and salary payable. There's FICA payable, which is Social Security and Medicare deductions. There's state tax withholdings, and then there's federal tax withholdings. There are more withholdings, such as insurance benefits, any 401k that's invested. But I'm just kind of doing a simplified version of it. And for salary, like the example here, I say, let's say employee earned $2,000 during his pay period. So basically, you'd recognize a salary wage expense for $2,000. You have a federal withholding payable for $150 right here. You have a state withholding payable for $75. You have a FICA payable for $25. And again, that's basically the withholdings for Social Security and Medicare. Just as a note, I believe it's 7.65% of the gross, up until I believe $110,000. And then you have salary and wage payable, basically, which is the sum of this subtracted by this amount, would be $1,750. So basically, this would be used in case you're processing the payroll, but you're not going to pay them right now. An interesting thing with FICA expense is that 7.65 is withheld from the employee's check, and 7.65 of that amount of the gross amount is also paid by the employer. So there's a matching amount that's done. So this is basically recognizing we're the employer and we have to pay whatever was deducted here. So we're debiting payroll tax expense. We're using that account to do that, and then we're doing FICA payable. There's payroll tax expense. I didn't move it over far enough. And then when we basically are paying our payroll taxes, we're basically emptying out the federal tax withholdings payable and the state tax withholdings payable to zero that out, and paying the bank out of the bank. We're paying $225 to those entities. We're also here's when we pay the FICA payable for the employee and employer portion. And when we do finally pay our employee, we write him a check for $1,750. All right, the last part is equity. Equity, there's an owner investment account, which basically is an owner's contribution to the business. There's a partner or shareholder contributions for other entities. So for example, if you're a single member LLC, you'd probably have something called member or owner contribution. If you have a partnership, it's partner contribution, and you would have a contribution account for each partner. And for like an S Corp or a C Corp, you would have a shareholder contribution from some of the smaller S and C corporations. And basically the way that's done is, I'm not sure if I did it. So for a single member LLC, for example, he says, okay, I'm gonna throw $5,000 into my business. So the bank is gonna receive $5,000, and there's a recognition of equity from the owner to the business for $5,000 in the form of owner's contribution. In terms of these debits and credits, one thing I always like to tell myself is sort of, what are we receiving and where is it going, or where did it come from? So I always think that's a good rule of thumb. That's just a tip. And on that note, I think we're done here for now. And our next video will be actually going through a business and doing some T accounts and things like that. So stay tuned. Thank you.